It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are managing your financial future. Once again, welcome back to the podcast. Loyal listeners and fans of the program, I'm Johnny Dean, your podcast host. Not an advisor, but here with an advisor, Professor Rick Plum, CFP. Hello, Rick.
Hello.
So last week, and welcome to we got some new folks listening, I'm told.
Oh, good.
Yeah, it's nice. We love new listeners. We don't want to keep introducing ourselves all the time, but you are a certified financial planner professional.
Yes.
And as we said last week, you have been for a very long time. Been doing this at Lucia Capital Group for a very long time as well.
Yep.
I've been a host of stuff for maybe as long as you've been a financial advisor, maybe longer.
Yeah.
We've both been doing this since the 80s.
All right, so you're basically saying we're both old.
We really are getting old. And I said last week, time is flying. And something else that you mentioned last week, and we had a question. Somebody asked us to cover this today. So I said, okay, I will do that because you brought this up at the end of podcast last week. And we were talking last week, kind of a complicated discussion, but an important discussion about things that you need to take care of before the end of the year.
Yes.
And we often do this before the end of most years. We try to remind people of some of the things that you need to do to take care of. One of the things that you brought up just kind of at the end of the list, it wasn't even on my list, but it should have been, was the topic of Roth conversions.
Yes. I mean, they are something that they happen during the year. That you can't do them after the end of the year. Unlike a contribution to an IRA, which I can do up until April 15th of the following year and have it count for this year, conversions happen and they are taxed in the year the money leaves the traditional account. So as
soon as it's out the door, that's when it's taxed.
Technically I could do a 60-day rollover. So in December, I could have them distribute the money to me, hold on to it for 50 some days, put it back into a Roth within that 60-day period. I didn't put it in the Roth until next year. It doesn't matter. The money came out this year. That's when the taxable event happens.
Yeah, and the thing that you just mentioned, be very, very careful about doing that. In fact, don't do it.
60 calendar days.
Yeah, that's a financial planning thing that actually used to be a lot easier or a lot friendlier to do many years ago.
Complicated, but we could do it a lot more.
But we can't do it now.
They took that away from us.
They took that away as all good things. Hey, they like that. Let's get rid of it. So Roth conversions. Now, I don't want to get too heavy into the tax stuff again because that would be 2 weeks in a row of heavy tax. But there is a tax element of this that we can't avoid.
Well, obviously, if you're doing a conversion, you're taking money out of a tax-deferred account, IRA, 401k, or otherwise, and moving it to a more tax-friendly account, the Roth account, but that becomes a taxable event. So if I'm taking, $5,000, $10,000, $100,000, whatever the number is, I have to show that on my tax return as a distribution. Now, It is not a penalty distribution, regardless of age, because it is ultimately ending up in another retirement account.
So any age can do this.
Any age can do this. And any age doesn't mean just young. Older people can do it too. The only thing with seasoned citizens are you cannot convert a required minimum distribution. So the required minimum distribution has to come out, but you can do conversions over and above that in any given year. Yep. And the key there was any given year. So to make it count as a taxable event in this tax return that we're going to have that we file in April, it has to happen before December 31st.
Yeah. So what we're talking about is taking money that you've got in a traditional IRA. In other words, one that you would that's got, I will say, pre-tax money in it, right?
And you can do this with 401ks. I know many 401ks now have both traditional 401k and Roth 401ks under the same basic umbrella, and you can choose which way to go with them.
But your workplace has to have a Roth 401k option.
You can't just pull money out for the sake of pulling it out. Hardship withdrawals don't count for conversions.
So you can't take a 401k and convert it to a Roth IRA.
Not if I'm still working there.
Yeah.
I mean, everything's got little caveats to it.
Right.
But
so
for the most part, no.
Let's just say
but if
no.
I have an old 401k, that company I no longer work for, I can roll that to a Roth IRA.
Yeah,
I have to show it as a taxable event.
Yes, and you can you can get into some.
So a couple of things are going on right now. We're coming towards the end of the year. Should we be considering Roth conversions for you? And that has to do with where you are in your financial life today and where you're expecting to be in your financial life in retirement. Does paying taxes today make sense to get tax-free income later on? Or is it not that beneficial? Because there is pain today. If I'm paying taxes today, I want to make sure that I got some benefit going out from it. But the other thing is we've got towards the end of it. Right now, we've got an unusual market in that we're down quite a bit.
Stock values are down.
And so in many respects, last year, if I did a $10,000 conversion, I may have been able to, let's say I had a certain security stock that was at $100 a share, and I could do $10,000 worth. What's that? 1,000 shares? I could convert 1,000 shares of it. Well, now if I wanted to do a $10,000 conversion, I can do 1,250 shares. I can get a lot more of that asset over. So if I really believe in that stock over the next, 10, 15, 20 years, I can do more conversion for the same tax dollar now than I could a year ago. Now, does that mean this is at the bottom? I don't know when the bottom is. It could go down further. And it really stinks. If I'd done a conversion last year, I converted $10,000 worth of stock, and now it's worth $8,000, but I still have to pay tax on that $10,000 last year. And it's like, wait a minute, that wasn't a good idea. And those are always second guessing. We're always second guessing these things.
But when you say that wasn't a good idea, Professor Plum, you're talking about from the timing standpoint. I could have, if I had waited, I could have potentially paid less or been able to today, convert more. So to go back and say, was a Roth conversion a year ago, or let's call it the end of 2021, was it a bad thing? Well, I don't think you can judge that yet.
Because the investment itself is not a 1 year investment. Yeah. The investment itself is a multiple year investment. And I say many, many years, 10, 15 in some respects. And then that's where we do the evaluation, not 1 year to the next year, because unless I'm converting short-term money, doing it last year and then taking it out this year or beyond, that's the difference. But these are long-term assets we're talking about converting, long-term investments, and you have to evaluate them on the long-term prospects of the returns.
So if I'm thinking about doing a Roth conversion, I'm looking at my financial statement and I'm saying, man, my values are down. I don't need the money for a while. But
I like these investments. The market's just kind of ugly right now.
I believe in them for the long haul.
Right.
Is now a good time to maybe take this money that's in a traditional IRA, let's call it, and move it to a Roth IRA? If I'm thinking about this, Professor Plum, what do I need to consider? What are the first things I need to consider?
What's it going to cost me
in taxes?
Well, that's the cost. What is it going to cost? What benefit am I going to get from this? Because doing it right now is going to cost me something. So I know that's a fairly easy one.
Potentially.
I know what my tax return, or I should know what my tax return looks like. I should know what it's going to cost me. If not, I can talk to my tax preparer if I have one, or try to do a pro forma on the tax program that you have at home and say, if I just added another $10,000, how much do my taxes go up by?
Or whatever the number is.
Or whatever the number is. And it is scaled, so you have to know a little bit about taxes if you're playing this on your own game. Right. And so it's just a matter of, what is it going to cost me? But then the other thing is, so what's the benefit in the future? The benefit is tax-free. But how much am I avoiding in taxes in the future? Will I even be paying taxes in the future? How much do I have in tax-deferred accounts now? Let's say I'm kind of late to the game. I'm 55, and I really haven't built much up. I've never been kind of self-employed, whatever, and I don't have much in tax-deferred accounts now, but I'm working pretty good now, and I've got a 401k available to me, so I'm going to start socking away that $27,000 this year, $30,000 next year. I'm going to start building it up over the next 10 years. How much am I actually going to have in traditional IRA by the time I retire? I mean, am I going to have $500,000? And if I have $500,000, that's going to basically create a $20,000 annual distribution. What am I going to pay in taxes? If I look at that, my Social Security, do I have a pension? What is my projected overall income going to look like, taxable income going to look like when I retire? If I'm in a pretty high bracket today, and I don't think I'm going to be in that high of a bracket in the future, I may not want to do the conversion now.
Because I'd be paying more taxes today than I would have if I just left it in the traditional
Correct.
account.
Now, on the other hand, if I'm finding myself in a position where I've got a lot of deductions this year, whatever the case, or my income may be lower this year, or I'm just taking a look at it and saying it's going to be about the same, maybe I'll be in more tax bracket in retirement because I'll have to pay taxes on my Social Security as well, and that distribution is going to nail me on that, or it could hurt me with all these other little triggers that happen out in tax world.
Right,
so,
which we'll get to. So
that makes sense. And the benefit is I'm going to pay a lot less in the future than I'm paying today. Or as in my case, my spouse, I expect my wife to live a lot longer than me. I mean, I haven't done the best job of taking care of myself. Average, 80-ish maybe.
But she does okay.
Well, she's going to live to be 100.
Okay. All right. So you're going to plan for that.
I'm not just looking at what my tax bill will be or what our tax bill will be as a joint filing couple. I'm looking at what she may be faced with after I'm gone as a single taxpayer and the expenses that she has at that point. Taxes are an expense. And as a percentage of income, they're less for a married couple for the same amount of income as for a single individual.
Well, the brackets are cut in half.
For the most part. And
Pretty much.
We're looking at, she's going to lose one of the Social Securities, the lower of the two Social Securities.
Assuming you go first.
Yeah. Well, assuming in either case, when one of us dies, somebody's going to lose a Social Security.
Yes, but yes.
Yeah. I'm planning for her, not for me.
Yes. I just wanted to throw that in.
Thank you.
Yeah.
So she's going to have less income. The portfolio will be the same, but she'll have less income and higher expenses. It would be nice to find a way for her to have less expenses. Now, that doesn't mean I want her to cut back on, traveling and seeing the grandkids and doing things like that. I want her to cut back, if possible, on paying taxes.
Well, I mean, of course. And we talked about required minimum distributions last time. Professor Plum, money in a Roth is not subject to any required minimum distributions, correct?
That is correct. And even if it was, it's non-taxable, assuming it's been at least 5 years.
Right.
So I'm looking for ways to make our situation, more efficient. And in that case, am I going to be paying more in taxes today on the conversion than we will when we take it out in the future?
So is the main consideration tax bracket now versus tax bracket when I would have taken it out?
It is one of the driving considerations, obviously, because I've shown people where this is where you are today. You'll be paying X amount of dollars in taxes, percent in taxes today. But if you wait until you're fully retired and you get out to, post RMD age, and you're going to have the distributions are going to be you're going to be eating you up alive. I mean, you're going to jump because not only will you have to pay taxes on the money coming out of the IRA, but you're going to be paying taxes on up to 85% of the Social Security. So it's a much higher effective bracket. That last 10 grand didn't cost you just 12% in today's world. It cost you 20% because of the taxation on Social Security.
So you're headed toward this gigantic mountain, this age 72, that you're going to collide with it, and it's going to be a big tax bill because you're going to have those large required minimum distributions.
So you may want to look into doing something now, and they'll say, yeah, that makes total sense. And then when it comes time to pay the tax, oh, this is horrible. And now we can't undo them.
Withhold the taxes. Then you don't see it.
But it's very hard to withhold the taxes, especially if you're not 70 or 59 and a half.
Well, no, that's true.
Because if I'm going to do, again, I just round numbers, $10,000
of a conversion,
and it's going to cost me $2,000 federal and state in taxes. I can't take $12,000 out and withhold $2,000 and convert $10,000. I mean, I can, but if I do that, the $10,000 that goes across is not penalized because that's a conversion. But the $2,000 that came out to pay the taxes, or I should say that was withheld to pay the taxes, that's a premature distribution.
If you're under age 59 and a half.
I'll have to pay taxes and penalties on that. So we have to identify where the tax money is coming from.
Very good point.
And if you don't have the tax money, then the Roth conversion discussion is kind of a moot point.
Well, that's true. I mean, you do have to have the money to pay the taxes.
But it's a matter of looking at that and also, are you willing to pay the taxes now? That's what I was going to get towards. You may see the benefit in it, but that pain today of paying those taxes, even if it does look like it makes sense in the future, it just still may not be enough to push me over the edge.
So when people have to write the check, you're saying they get
cut back on their paycheck because they were withholding more, or write a bigger estimated check. Yeah, however the taxes are going to get paid.
There is a cost to it.
There's a cost.
And maybe the other thing is I'm paying for something now that I won't really see a benefit for quite a while in some cases.
Or in my case, ever, because the way I'm looking at it, I'll be dead.
Well, all right,
I'm doing a benefit for somebody else.
But it's for the two of you. So yes, I get it.
And some people will do it for the benefit of their children, because their kids will probably inherit it in their highest earning years.
Boy, can you imagine
and
that?
with the 10-year payout now, with the non-spouse beneficiary rules, no stretch IRA.
That's true.
They inherit it when they're in their 50s.
What nice parents to say, we'll even pay the taxes for you.
Well, if I'm in a position where I can pay it at 12 and they would normally pay it at a higher bracket.
Well, do you see some people who are retired who all of a sudden are in basically a zero bracket?
That is true. There are people that should be doing conversions because they're in a 0% bracket. I know people that have very good Social Securities. I know one couple, the gentleman has a disability retirement.
Yeah.
So it's tax-free. And so the only thing they show on their tax return, if they filed a tax return, is their Social Security. But because the only thing that's on the tax return is Social Security, they don't even file a return. But that means that they have some ability to take some money out of their IRAs completely tax-free. Now, if they don't need it, convert it. Help the kids out. And it doesn't cost them a dime. Now, it's not like they're doing $100,000 a year, but they can do $15,000, $20,000 a year of conversions, depending upon some other factors.
Yeah.
And
why not?
Tax-free.
Take advantage of it when that window is open. So there are some reasons for doing this, but you know what? There are some other things that you were kind of hinting at before that you need to consider. Now, depending on your age and your income, if you do a big conversion this year, you might trigger some higher Medicare premiums.
Well, for retirees, people 65 and older that are on Medicare,
right?
If your total adjusted gross income goes over certain thresholds, you get the privilege 2 years from now of paying more for your Medicare premium.
Irma, I think is her
income-related monthly adjustment amount.
Her name.
And we just had a reduction in our Medicare premiums for next year. They went down by $5.20 a month
for 2023
per person.
Yeah.
So I don't know if you want to increase those again. But yes.
Well, what happens? There's an income threshold. I said depending on your age and your income.
Right.
What is the income threshold generally?
For 2022, we're looking back 2 years to the 2020 return.
Yeah.
And if the single taxpayer was more than 90, I think it was 91,000, married couple over 182, then they have the privilege of paying more for their Medicare. Now, each year that number goes up a little bit.
The amount that you have to pay extra?
Well, that too, but I'm talking about the threshold.
Oh, okay. Yeah.
It goes up a little bit every year.
Sure.
And next
so you can earn a little more.
A little more. So we don't exactly, like if you're doing a conversion this year and you're looking at how it's going to affect your income in 2024 or your Medicare premium in 2024, we don't have an exact number on what you can run your income to, because we know what the income limit is for 2022 based on 2020's income.
But yeah, and the reason for that is because by the time they figure out that you owe this IRMA,
well, they can't match up your tax return until you actually file it.
Yeah,
and Social Security can't match it up until it's filed and been
it takes 2 years.
It takes 2 years because 2022 the tax return won't be filed until 2023, and it takes them a little while to match up the IRS records with the Social Security records.
Yeah.
So it's the 2022 return is going to be affecting the 2024 income and down the backwards and forwards. So it's just a matter of, are you going to trigger something that you may not want to trigger? Now, the income levels are decent. And so, but if you're in those areas, and a lot of the times you're in those areas, you have pensions, you have very good Social Securities, you have other sources of income, and you've got large tax deferred accounts, and the required minimum distributions can be fairly, sizable from a tax standpoint.
Sure. Oh yeah.
And that's where we want to, if possible, look at what we can do to that before we get to the Medicare premium stage, before those premiums can go up as high as $500 a month, basically for one person per person.
Is it 500?
I don't remember the exact number right now, but it's close to $500 a month at the very high end.
It's a lot. That's a pretty high income, but yeah,
well,
it could potentially be
500,000.
Well, that's high, but yes.
Oh, you pop. No, I'm kidding.
Well, I mean, if you're making that at retirement, you've done very well.
Well, and yes, I mean, but remember, that's not just a matter of what you're making in retirement. That could be the sale of a property.
That's true. A one-time deal.
It's not once you're in it, you're always in it. It's a year-by-year calculation.
Where somebody's Medicare premium went up considerably because they sold a vacation home.
Yeah, they sold a house with a $500,000 gain.
Mm-hmm.
You know, and the way housing prices went up the last couple of years, that's not unheard of.
Mm-hmm.
And that can affect your Medicare premium 2 years later, just for the 1 year, because you only had the spike in income for 1 year.
Now you're talking about the Medicare Part B premiums.
Part B,
that
C,
could be
and D.
affected, but yeah, C and D could also go up as well.
Medicare Part C basically goes off Medicare Part B.
Yeah, so we'll say Part D could increase. So that's one thing you got to look out for if you're going to do this.
Right, but you need to know these types of things so you can. Because what was the first thing you said? What do you have to consider first? The cost. And this is part of the cost.
And another cost that often gets overlooked, but you brought it up a little bit ago, has to do with your Social Security benefits.
Well, I remember years ago we were talking on the radio when we had our radio show. A gentleman called in and said, "I did a $10,000 conversion. Roth conversion. Why did my taxes?" This was quite a while ago because we were in the 15% brackets back then. It was 2017. He said, "Why did my taxes go up by $2,200 on a $10,000 conversion?"
That sounds like a 22% tax.
Yeah, he goes, "I was in the 15% bracket. Why did it go up so much?" Well, it's because you had to include Social Security now as a taxable event as well. So you weren't just paying tax on that dollar or X dollars of distribution. You were paying tax on $1.85 for every dollar you converted.
Yeah.
And so you need to know where you are in that situation. These were people that were on Social Security, and now they had to pay tax on Social Security that wasn't taxable before they had this, because taxability of Social Security is based on other income. Now they had more other income.
It's one that hits people because you don't see it right up front. I mean, the Social Security taxation, it looks all good until you look at your tax bill and you say, wait a minute, what happened?
And it's a convoluted formula.
Big time.
It's an interesting formula. It's not straightforward. It's not like you hit X and automatically 50% of your Social Security is taxable.
No, it goes up.
It goes up gradually.
Incrementally.
And then it gains speed when you go past the second threshold.
There are two. That is true.
Yeah.
Is it? And that threshold has not changed.
Well, they put the initial thresholds in for the 50%.
The income thresholds we're talking about.
For up to 50% of your Social Security to be taxable, they set that threshold in 1983.
It has it gone up?
Has not changed since then.
So more and more people are subject to this the Social Security.
And then in 1993, they put in a temporary tax, an increase in the taxability of Social Security to go up to as much as 85%, and they set the threshold in 1993, and they haven't changed that one since, and they made it permanent.
I was going to say, we're at the 30th anniversary of that temporary increase, right?
Yeah.
So, whether you like it or not, those are just some of those are the things and that you need to think about. And I mentioned the Social Security tax because there are people, Professor Plum, who could have been receiving their Social Security benefits from age 62.
Right.
They've reached age 72.
And now they have required minimum
distributions. They didn't give it any thought because their Social Security was never taxed.
Yeah, they weren't. In many cases, they were never paying any taxes on anything.
In some, that may be true.
Zero tax for the past 10 years, and now they're going to jump. And depending upon how much they've let their IRA grow for the last 10 years, and it grew fairly nicely for the first 9 of those 10 years.
Let's hope year 11's you better. But anyway,
but all of a sudden now they're going to be paying a bunch of tax. Maybe they've been living on personal money because they've read all the financial journalists that say, use your personal money first, never touch your IRA. Hey, if you're going to do that, don't give up good. If you've got tax treatment that you can do in a really low bracket, take advantage of it.
So they could wind up seeing their Social Security benefits taxed for the first time ever, and they could potentially wind up seeing their Medicare premiums rise
quite a bit
as from the income-related monthly adjustment amount, the IRMA. Again, 2 surprises. One other one that I'll bring up that could be a potential surprise has to do with the NIT, not the National Invitation Tournament.
NIT.
Well, that's true. Yes, we have the net in the net. Did I say NIT?
Yes.
It is the net investment in.
The net investment income tax.
Right.
NIIT.
NIIT. Thank you.
Now,
yes.
That's at a higher limit. Obviously, it's a much higher limit, but it does happen.
It does happen. So if you would explain, please, what this is like. Is it 3, almost 4%?
3.8.
3.8%. Explain what this is.
If your adjusted gross income as a single taxpayer is over $200,000 and you have investment income, dividends, interest, capital gains, things of that nature, your capital gain rate goes up by 3.8% on any gain that is part of your adjusted gross income above 200,000. Married couple, it's the amount over 250.
Yeah, there's a big marriage penalty there.
So the capital gain rates are 0, 15% if you're over roughly $100,000 as a married couple and you have capital gains above that, and it could go to 20% if you have a lot of capital gains over like 400,000 or 500,000. But once you get over 250, there's a little stealth little thing in there that adds another 3.8% to all the interest income that you have, all the
once
dividends.
As a married couple, your AGI goes over 250. That's not a magi. That's an AG.
There's a small adjustment to it, but not. It is a magi. But
all right.
Look at your adjusted gross
for all
income.
intents and purposes.
And for a married or for a single person, it's 200. So you start adding on an extra 3.8%. Same thing though. If you're working, there's an additional Medicare premium on your salary. If you go over 200,000 as a single individual, 250 as a married couple, you get to pay higher Medicare tax, not the premium. You're not on Medicare yet. You're working.
Yeah, interesting.
But you get an extra 0.9.
and Medicare taxes, doesn't matter your income, you are subject to it. Social Security, FICA taxes
on earned income
drop off above whatever it is now. I don't even know.
142,700. Something like that. And next year it's 162,000. Goes up quite a bit.
Wow.
But the Medicare tax, it's part of the FICA Medicare. As an employee, I pay 1.45%. My employer also pays 1.45% on 100% of whatever I earn as salary, wages, and things of that nature. Combined, 2.9%. When you go over the 200, 250, they add a 0.9, bringing it up to a 3.8. Heard that number a few minutes ago, didn't I?
Wait, so it's 0.9 that you as the employee pay, and it's 0.9 that your employer.
No, the employer doesn't pick up the extra one. The employer only pays the 1.45.
Oh,
because
so it's
they have no idea what your overall
that's
income
true.
is.
Yeah, that's true.
And so the 3.8, so it's the same 3.8% Medicare tax that they charge on net investments over 200, single, 250 married. My Medicare premium that I pay, but I'm already paying 2.9% on under that, so they add it. So it comes.
So you get a tax bill. See, the thing
it becomes part of your total taxes owed. It's all done on your tax return.
And they find this out later
when you file your tax return.
Yeah. So the problem is, see, when you're doing Medicare premiums, it comes out. You don't really think about.
Well, that's Medicare premiums. This is the Medicare tax.
No, I understand. Yes. So
no, it's right away. So it's on the tax return. So if I'm filing my tax return for next year, early next year, I'm doing my 2022 tax return.
Yeah, it'll be on that return.
And I'm blessed enough to be over, if I'm over that 250 as a married couple.
Yeah.
There will be another schedule that talks about the additional Medicare premiums, and then it'll be added into the line that says this is your total taxes owed.
So you could get hit if you just the things you need to watch out for with as we get heavy into taxes. And I didn't want to do that.
Didn't want to get complicated, but you brought up taxes.
Well, because this is something you have to think about when you're doing a Roth conversion. One of the drivers you said was, is my tax bracket now going to be higher or
What's
lower?
My cost?
What's my cost? But figuring the cost is not necessarily just your tax bracket now versus tax bracket later.
It's not just the income tax. It could potentially be the tax on Social Security. It could be the tax on your Medicare premium. It could be the tax on the additional net investment income tax. It could be the tax on your wages, the additional 0.9%. Not that that's a big number, but it's still it's a number.
It's a number. And so once again, I would advise people to remember back in the late 90s, I know we've talked about this before, when Roths first came out, 1998, there was a big push to get people to convert to Roth. Why? Because it's tax-free going forward. It's a big thing,
and
right?
I saw one of the biggest mistakes with a Roth conversion I've ever seen happen in 1998.
Well, and very quickly explain why that is.
In 1998, you could not do a Roth conversion if your overall income was over $100,000.
And that was single or married.
Right. That was just flat.
Everybody.
I met somebody whose income was like 99.9. I mean, it was pretty close, but he wasn't over the 100. And he felt very strongly about the Roth IRA. And he had a $600,000 traditional IRA. Now, back in the first year we had Roth IRAs, the government, to entice us to do this, said, we'll let you spread the taxation over 4 years.
So you find out what your tax bill would be, and you divide it by 4, and you
Not that complicated.
Oh.
They took the conversion amount, and in this case, it was $600,000. You divide the conversion amount by 4, and you show that taxable amount in each year.
Okay, all right.
So he's paying taxes. He did a conversion of $600,000 in late 1998.
Oh, yes.
And so he had to pay taxes in 1998 on $150,000 of the conversion. 1999, $150,000 of the conversion. 2000, $150,000 of the conversion. 2001, $150,000 of the conversion.
Now, you mentioned the years 2000, 2001.
Yes.
That rings a bell.
And he was heavily teched up. And his $600,000 Roth IRA looked really nice for the first year or so. Was going up.
What was it by like 2001?
It was about $120,000.
And yet he's paying taxes on
Yeah,
money that he doesn't.
he's already paid tax on 450 of it. Now he's got to pay tax on another 150,
Right.
and it's not even worth 150. And at that point, we could undo Roth conversions if we did them in time. But his didn't start falling until after the time period ended.
So here's the deal. You see, so this answers the question, which I think is probably going to be the title of this week's episode, which is now a good time to do a Roth conversion? We asked this a year ago, and I'm asking it again because as values are down relative to where they were a year ago,
yes,
and we don't know where they're going.
No, we do not.
They could still go lower. We don't know. But as values are down overall across the markets, would you say that now is a good time to at least consider doing a Roth conversion, given that the values are down?
I think now is the starting point to look. Yeah, it's more enticing to me now than it was a year ago. But I still want to look at where I am on the brackets, what it's going to cost me, and I don't want to necessarily do 100% of it like this previous gentleman did. I would do it in measured amounts. A, because I can afford the tax bill easier.
Yeah.
B, it's just I don't want to go too high. I don't want to jump brackets either. I don't want to jump marginal brackets. I don't want to jump IRMA. I don't want to jump NIIT.
Mm-hmm.
I don't want to jump any of that. I just want to I want to know what's efficient. I want to know what's appropriate for me. But yeah, I think that the fact that it's down gives me a little bit more push to do it than in other years.
So if you're thinking about this, talk to your financial advisor and find out where you are. Where you are in the tax brackets. Find out if you did something like a Roth conversion, what's it going to affect? Are you collecting Social Security? If you're not, then you don't have to worry about that.
Yeah.
But there may be other things that you got to worry about, right? Medicare premiums.
There's always something in the tax code lurking.
Yes, there is. And there are potential landmines everywhere. So talk to your advisor before you do a Roth conversion and make sure, or
just
at least understand what you're getting into.
Yes.
Yeah, because it could be great.
Okay.
Ultimately,
it could be wonderful.
Well, there are barriers to entry, as they say, right? So you got to understand what those are. The folks at Lucia Capital Group, they do this every single day. They talk to their clients about this, and I would suggest that you give them a call. Either talk to Professor Rick Plum or any of the Lucia Capital Group advisors who work with him. 800-644-1150. That's the number at Lucia Capital Group. 800-644-1150. As I said, they do this kind of stuff every day. It's a lot of technical analysis. You have to look and see. You have to make certain projections, but you got to also understand the tax code. If I do X, what's going to happen as a result? If I step over here, is this going to trigger something else?
Correct.
And that's the important part of this. So again, Lucia Capital Group, 800-644-1150. Also, the website, we got a lot of stuff on Roth conversions. Check it out, luciacap.com, luciacap.com. Spotify is where our podcast lives, and we hope you're there. Of course, if you're listening, that's probably where you found us. Make sure you subscribe to us. You won't miss a single episode. And if you have any suggestions or questions, you can certainly write us. Go to our website, luciacap.com, and you can ask the Brain Trust. And, hey, maybe we'll talk about it. Professor Plum, thank you so much.
You're welcome.
We kept this, I think, as simple as possible. Just know the pitfalls. I
Yes.
think that's what we wanted to say.
Cost benefit.
Professor Rick Plum, for Professor Rick Plum, CFP, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.